Good morning, a video morning brief of the U.S. stock market Wednesday, January 8, 7:53 a.m. Eastern Time. I'm Rich Posh for Critical Point. Okay, hourly chart, S&P 500 cash gives us pretty much of a clue of Dow Jones and NASDAQ and most of the sub-indexes. Market pulled down into filling a gap, snapped back up yesterday, sold it down, they gave in, pulled it down to just about ready to fill this gap. I suspect the way the futures are behaving this morning, it's probably going to try to pull down and fill that gap. Now, that may be self-fulfilling prophecy, and they may be ready to put it right back up. It's quite possible this market is just stalling, and when the market stalls, it basically means it moves sideways. It still has to try to do something. It just can't get traction to develop an actual trend that people can sink their teeth into. All right, they have to be shorter and shorter term traders. And we're seeing evidence the level 1, level 2 trader has sold a sizable portion. They pretty much sold everything they bought since late spring, summer of last year, okay? Now, we have seen a pickup of the size of positions for level 3, level 4 traders and day traders. So they're kind of picking up the slack here. They're taking that supply and trying to trade. It may also be a sign level 1, level 2 traders are more interested in trading faster. And this is probably a sign of risk management, or that they feel the market's going nowheres and they have to trade faster. We believe some sectors of the long-term investor and long-term type trader have sold, backed off in positions, but we also believe there's others still trying to be bargain hunters and buying on the way down. All right, let's go to the futures now, and let's go to the S&P 500 futures and model analysis. And the model is saying if a level 4 bottom occurred on January 6th, then yesterday's breakdown was bearish action, and I was betting on the downside day trading. I didn't like the looks of it. I pulled out, however, and basically want to just sit still now. And I'm also in 100% cash for all of my other accounts here, and we're just going to watch the market, and hopefully it's just going to drop to a lower, better price to buy. The next level 4 bottom, okay, is due later today, but it's looking like it's 1 p.m. today into tomorrow. Now, there's some other weird things going on. This bottom on January 6th might have occurred overnight trade on January 7th. That would actually shove this out so it can stay down still longer, okay? Now, it is oversold on an intraday basis, so yes, the market can bounce, and it is due for at least a little blip up for a few hours into a level 4 top. I think what this is telling me is it's rather limited upside now. This market is feeling heavier by the moment, by the minute, okay? I wonder if it isn't ready to even take a plunge. I don't know if I really want to forecast that. It's a difficult thing to forecast, but it's feeling heavier. Now, this is the 12-hour chart, and what I've noticed is the futures overnight came down to just about that low on January 7th. So that low in the futures is 59.35 even for the March E-mini S&P 500 futures. What I'm telling you, if it goes below it today, we don't even have to wait to 1 p.m. If it goes below it today, that's too late to assume yesterday's low was a level 4 bottom. So we do have to put it back up into there. Now, that means it could still bottom at 1 p.m. and later, but it also opens the door to go lower. So I would say half to 2/3 of the scenarios or model scripts are saying lower tomorrow as well, but they're allowing for a brief little blip up for the level 4s. I got a feeling this level 4 trading is going to be difficult to do. I think there's something more serious going on where these level 4s are combining for a more intense, serious downtrend. I just wonder if the market's ready to collapse. And at the same time, I can see that it's really just going to range trade. So not a lot of help from these level 4s. This is the S&P 500 cash. Filled the gap, looks ugly, could still bounce, still go higher anyways. But the best forecast is people might become frustrated with this 40-day moving average and the 50-day moving average, and they might be concerned of dipping below the 5-day average. That's now bearish relative to the 40s and 50s. I wonder if they aren't going to eye the 100-day moving average at 58 13 eye the rest of this gap and just saying, come on, let's just get it done. Now let's go to the daily S&P 500 futures, and very convinced that's the level 3 top as of January 6th. It really isn't there. I'm leaving it that there. We can come up with other alternate scenarios. Doesn't really matter at this point. I think we got to assume the last bottom, okay, was on January 2nd. The trend is now down into next week, if not the following week for level 3. That's quite a few days. We can at least allow it to go down 1, 2, 3, 4 additional trading days, business days, and it might go down for 10 business or trading days, okay? And that's long enough time to be quite ugly. And so now let's zoom out and look at and watch this 5-day average as a pivot here, okay? Now let's go to, yesterday I think I showed you some of the NASDAQ stuff that I was using as a leader, the cash, and there it is. It blipped above our tentative trend line, snapped below it. Next day they blipped it just a little above, couldn't do it, they nailed it. This tentative trend line has now been proven. It could be a level of where they start selling yet again if the market does move up, okay? Now, filled the gap back to the 5-day average, and they decided they'd done enough business for the day, all right? Daily indicators still acting bullish as of the close yesterday, but the futures are warning it might give in and roll over for a sell signal. It is near mid-range, okay? And same story as the S&P 500 cash, level 3 bottom, level 3 top, down into next week, maybe later, okay? All right, we also know that NVIDIA led some of this bounce, and then look at NVIDIA on a daily basis, spiked it, put it down, filled the gap, looks ugly, closed on the low end of the day. They call that a low range close, okay? Outside day as well, meaning the low and high was outside the low and high of this, or even if you fill in the gap, same story. A bit of a bearish side, abrupt turn, all right? And then this is the Mag 7 looking ugly, okay? So next up, let's go to the weekly chart and touch base again on where we're going. And this weekly bar candle for this week for the S&P 500 looks pretty negative. Now I have to see what it looks like at the end of the week. And they put it above the 5-week average. They put it up to this trend line, sold it back below the 5-week average. It looks ugly to me. The weekly indicator, however, really hasn't responded much. It's acting like it would like to bottom, but it hasn't given a buy signal. If they push this lower, it could save that from a buy signal and start spreading that back out and act bearish. Now here's something to watch. I was telling you watch yesterday's low in the futures, and I gave you a price in the futures. That could be a clue it's going down today and perhaps even down into tomorrow, okay? Now on a weekly basis, I'm telling you if this is a level 3 bottom and that's a level 3 top, it ought to be down, and this little line right here is the model's best guess of when the next level 3 bottom's coming. It's saying next week or the following week. Now, it's then saying, taking a guess, starting from the earliest part there, and saying this is the next period of 2 weeks to bottom. The problem is if it bottoms late there, it's probably going to shove that out or give it one more week time for the next one. What's this implying? Bottom, an up move in between, a top, then pull it back into a bottom. All of that can occur during this line, which is telling us the amount of time we have for far more important level 2 and level 1 bottoms that could lead to at least a bounce in February and may lead to a rally into April, May, June that would then lead to a big decline perhaps April, May, June, July, okay? So the model's saying if the market bottomed here for level 1, then this 2-week period and this 2-week period, those bottoms ought to be higher than that bottom, which is at 5829.53. If this is not a level 1 bottom, then the model's saying it really should come back to near it for some kind of secondary bottom, test bottom, double bottom, but ideally will go lower than that, So it can trade below 5829.53 now into early February. In addition, we have objectives that are suggesting a chance to go to below 5,800. We even have this box at around 5740s on down now to 5,500. We have these three lines that were used in the past that could be used again. We have the election low could be a floor price, but also a downside target. So there's small amount of downside potential to a large amount of downside potential. And the downside potential time-wise is anywhere into early February. Yet it is possible they're going to put the brakes on now in the next few weeks and not take it below last week's low. What is our best forecast if you make us get off the fence of will it take out last week's low or not? We think it's going to take out last week's low. We think it's going lower, and we think there's no reason to get excited about buying this market until it trades above the high of this week at 6,021.04. And as I told you, we really can't believe that we're back on track for long-term bull markets into 2026, into 2028, 2031, until it takes out the record high at 6,099.97. Sometime Jan-Feb, but better still after February, okay? And then another hurdle to watch is after August. If it's record high after that, it ought to be higher in 2026. Okay, so that's what we're looking at here. I think we've got more downside in Dow Jones, NASDAQ, and the S&P 500. And I don't like the breadth. I don't like the percent stocks over the 200-day average. The VIX can pick its head up. We're not forecasting any massive up move in VIX, but it can move higher. And then what we want to consider is the broad base. The S&P 1500 looks just like the S&P 500. We have the 400 looking very weak. We have the Russell 2000s at least somewhat weak. Okay. It looks like this is across the board problems and complications here. And then we have the S&P 500 equal weighted index. Looks like a level 3 top. Couldn't sustain it above the 5-week average. Looks like it's heading lower into next week, following week for level 3 bottom, and quite possibly a level 1, and also can delay with another level 3 bottom, lower still into early Feb. All right. Now, the next thing to watch out for is interest rates, because people feel like the stock market is really upset over the interest rates, and we got a bigger up move than what I thought we would get for the start of this year. At least we're up, okay, as we thought, and we're now giving even more time. It can rally towards the Federal Reserve meeting later this month. Now, there's conflicting reasons of why it's doing this, but we also want to watch Japan carry trade and Japan interest rates and Japan currency, because it may force them to raise interest rates that may shock the Japan carry trade and create something like back in July and August that could then be a contagion and shock the rest of the world. I think they've learned their lesson, and they adjusted their carry trades so that they can do it a little better and not crash it that much like they did back in July and August. And it may not even occur, but it is something to watch out globally that could impact the U.S. market. Now, in the U.S. market, we have worries over lots of debt coming to be rolled over, to become to higher interest rates and cause greater expenses to business as well as to the government, okay? And then we also have new debt that can come in that people are wondering how well can the market handle it, both from the government and the private sector. We have real estate speculation is incredibly high, and that's bothering people that something's wrong. They're going to get burned when they find there isn't enough people to buy those homes. Can that upset the overall real estate market, which is important to the overall economy? Therefore, can it upset the economy? Now, on the Trump news, we still have the Greenland or Iceland or whatever it is, where they just want to get that land for energy, natural resources, shipping. We have the Panama. A lot of this stuff is viewed as nonsense, but it's upsetting. We still have Trump coming out even yesterday morning after the Washington Post article that said Trump would not do as much of that tariff stuff, and Trump said, oh, yes, no, that he is going to do that, okay? and we have issues, and now we have Trudeau leaving his position in Canada. We have Mexico even doubling down, saying, hey, if U.S. wants to fight, we're going to fight. We have China that's now sanctioning 20 additional companies. Okay, this can escalate and hurt the U.S. economy, and yet we could still even get higher inflation, and there is fear in the market right now of higher inflation. Even I'm concerned of it in the next 2 to 5 years. Don't know how extreme that will get. I'm saying for the U.S. stock market, until we get a record high, okay, and I prefer the better hurdle is record high after February. Until we get that, and this is the monthly chart of the S&P 500 futures, same picture as the cash market, till we get a record high, okay, specifically in the cash, all right, and hopefully the other major indexes as well. We should assume there's a chance we're in a bear market until October, -7 to -36%. If it's an LT2 top in December as well, we should assume -13% to -36%, okay? This could be a great overreaction, that it doesn't have to be that bearish, and certainly doesn't have to be that bearish that long. The bear market could be over by April, May, June, July, and then move higher, okay? And it doesn't have to really work. We may learn as soon as by Jan, Feb, March, April, that the market pounded out a record high anyways, and that would limit that downside so that we might only have to worry about a -7 to -11 to maybe -13% this year. We won't have to worry about -15, -20, -36%. So we need that to kind of limit the amount of downside. Otherwise, I'm concerned this market could really get ugly in coming months, or it can at least stall for a few months to several months. It's just one of those markets that it could be far more bearish than what people realize. And one of the better of hedge fund managers on the value side just came out and said, we're dealing with a bubble here. We should not ignore the high valuations, overvaluations. But he wasn't necessarily calling a top or saying to be bearish. He was just warning of it. But he's one of the better ones in value type stocks, while I have a value index that looks quite bearish. I think it's topped out. So I don't like the LT3 is such a fickle thing, in a sense it might only provide a buy the dip moment. It may provide a correction of 10%, which is Wall Street's definition, or it may provide an actual Wall Street definition, bear market of -20% or more. So it's all over the map for performance, so it makes it difficult to work with. But I think until we get that record high, with all the crazy stuff that could be going on in coming weeks, months, I think we want to err on the side. We very well could be in a bear market now. Now, with any luck at all, that bear market is inside of a much longer term bull market, meaning we'll get through this. But the warning is there could be a lot more downside here than people realize. And as I look at this monthly chart, it's working on a negative monthly reversal. I think it needs to go lower, ideally into February, but it can bottom this month. Starts trading above the high of this month for these cash indexes, Dow Jones, NASDAQ, S&P 500. That would be a positive development. In the meantime, I got to be bearish here. I think bulls have to be very, very careful how they're dealing and working with this, okay? So I'm going to wait to see next week. Maybe we'll call a level 1 bottom then, take a chance anyways, but I'm nervous. This market may not do much for the first half of the year, and maybe the more bullish stuff is coming second half of this year. And it doesn't even have to be bullish into after October. That's one of the frustrating things here of multiple scenarios. It could take quite a while. It can be down a lot. It can be down less and shorter periods of times. It's rather complicated, and it has to do a lot with the Trump policies that are going to go on and impact our economy and business. Past results are not necessarily indicative of future results. Have a great day. Thank you.